what is WACC? Why is it important? How can we use and analyze WACC? WACC stands for weighted average cost of capital, and it tells us how much it costs a company to borrow from the public and from debt. So all the definitions are right here if you have any trouble with them. So how can we calculate it? Well, it's market cap divided by market cap plus debt, which is just the weighting. That tells us how much the equity weighting will be, times the cost of equity, which I have this broken down. I'll go on that. I'll speak about that in a second. Plus debt over equity plus debt. That is also just the weighting of the debt. Times cost of debt times 1 minus the effective tax rate. So that's how it's calculated. So here's an example. A $10 billion market cap company has $1 billion in debt, beta of 1.5. The risk-free rate, which is government bonds essentially, is 4%. Tax expense is $100 million. Interest expense is $100 million. And income before tax is $1 billion. That means that the cost of debt, or how much it costs for the debt, is going to be 10% minus the tax rate. So it'll be slightly less, about 9%. Let's see here. So cost of equity is beta. It goes off beta, risk-free rate, market return. So market return is essentially the S&P 500 or whatever you think the market will return over a period of time. So I have 8% here. Beta 1.5. That means that for every dollar the S&P 500 moves up or down, it's moving up or down $1 kind of pegged to it. The risk-free rate is 4%. So that's essentially what government bonds are yielding. Let's see, so the calculation is risk-free rate plus beta times market return minus the risk-free rate. So 4% times 1.5 times 8% minus the 4% risk-free rate is 12%. So it's basically just beta times market return for cost of equity if you want to simplify it. Cost of debt, let's see here, would be, so you take your short-term debt, your long-term debt, that's your total debt, interest expense over total debt, minus the tax rate. So $100 million in interest expenses over $1 billion, that's 10%, minus 1 minus the effective tax rate, which is also 10%, gives us 9%. So that would be 10 billion over 10 billion plus $1 billion, times, so times the 12% cost of equity plus the weighting, these are just weightings, times the 10% interest expense times the effective tax rate, 1 minus the effective tax rate. That gives us 11.8% weighted. So it's down here, the whole formula. Okay, so why is it important? Well, if a company has an 11.81% weighted average cost of capital, that's quite high. That means that investors expect quite a lot from the company. They expect 12%, and even the bonds, I mean, they're paying 9% effective rate of 9% on those bonds, which is quite a lot. It might be, something to look into here. That's quite a high rate. Maybe not today, I guess, because rates are rising, but normally it's a very high rate. Let's see. So how can we use and analyze WACC, or weighted average cost of capital? Well, it's usually we analyze it based off of what is the company returning, essentially, like the ROIC. I think this is a very good measure to analyze it against. I really think this is really good here, really good measure here. So ROIC, I usually use free cash flow because I think it's a better measure, but you can use net income. So free cash flow or net income over invested capital. So what is invested capital? Current assets minus current liabilities, minus cash plus fixed long-term assets. Let's see here. So what does that mean? Well, let's see here. High WACC, low ROC equals no good. If it costs a lot of money for a company to borrow, or investors expect a lot from the company, and they have a low return on invested capital, that's not a good, that's a recipe for disaster. So if you had, I don't know, a WACC of, let's see, a WACC of, I don't know, 15%, and they had ROIC of, let's say, 10%, that's terrible. I mean, so I don't know what they're paying on the debt, but there's a good chance of paying more on the debt than they are actually receiving in the business. So they're losing money effectively. Let's see. A company must be able to redeploy profits at a high ROIC to compound money. So if a company can get a 30% ROIC and they can take all the profits and redeploy them at that 30%, I mean, that's something that's going to compound your money no matter how much you pay over book. Let's see. A company only gets ROIC on BVPS, book value per share. Example, $100 stock trades at 10 times book. That means that the company earns a return only on that $10 a book. So if they trade at 10 times book, 100 divided by 10 is 10. So they have $10 underneath that stock of book value. And if they earn a 20% ROIC, that's great, but only making that on that $10, which is $2 a year effectively. And they can redeploy that capital at that 20%, which is probably why it trades at such a big premium here. Let's see. Let's see here. Yeah, so that's essentially what this is saying right here, which is why a low price to book is good. So if a company trades at $120 and they have $10 of book value, they're trading at a 12 times price to book, which is quite high.